Pratik, good morning. Thank you for joining us. Pratik, it's a situation of glass half full, glass half empty. Are you a believer in glass half full or a believer of glass half empty?
At this point in time, I would still, want to be more bullish than bearish. Because what has happened is that one part of the market where a lot of news came in, and good results happened, the index-heavy part of the market, that's run up and pulled up indices. Maybe there the valuations are looking okay for the time being. Maybe no further upsides may be there. But the other half of the Nifty, let's say, which will still be looking at declaring results going forward, that's the part where in any which way you expected numbers to be good. So as those numbers come in, one should expect that part of the market to provide some bit of upward momentum. And then one should not forget that we have an RBI policy a week or hence from now, and hence interest rate sensitives which have been cooling off for some time can again look up. Plus the fact that the result season is going off quite well, and after the result season one should expect the earnings expectations going forward to be bumped up a bit. This would be a sharp contrast to previous quarters wherein earning expectations were bumped down rather than being bumped up.
Well, we've seen a good bout of earnings from the IT pack. Pratik, do you see what came out of HUL as a trend for the consumption for the FMCG space? Or is it just a one-off?
In terms of sales growth, yes, there has been some disappointment, but the bigger one has been the increase in royalty that company has done. Our sense is one should look at staples in two baskets. One, consumer staples, the other food odd companies. Food kind of companies had going very tough over the last 2 quarters. There things seem to have stabilized, and one would be more positive on the food companies rather than on consumer staples.
Pratik, but most of the MNC companies, they charge nearly 3 to 5% of the total revenue in form of royalty. So what HUL is proposing is that they will charge about 3.3%, and that again will be extended till 2018. So if I look at what industry is charging versus what HUL is proposing, it's not a big number.
Yeah, but then, one, you were doing a lower number earlier, so where is the rationale of a higher number? We did not see boards opposing such kind of a levy or justifying it in any manner. So that came as a bit of a surprise. I think boards took a particularly strong stand in the case of ACC Ambuja, where something similar was proposed. It's not that it's a right of somebody to impose a royalty. It has to be justified. It almost seems like it is a right, and as soon as Government of India allows an increase in royalty rates, we find everybody increasing it. Frankly, it would basically end up meaning that the small investors in such companies would continue to get shortchanged. As and when business starts to look up and they believe free cash flows would increase, somebody would come and increase royalty rates to the benefit of only one investor. So that is been an extremely disappointing thing.
So in the same light, are you also negative on other MNC companies which charge royalty? Maruti, ABB, Glaxo Consumer, Cummins?
No, so you are right. High royalty rates is a big negative as far as MNCs go, but for companies which have been charging it and generating after that free cash flows, you tend to value the free cash flows after royalty, unless you believe the royalty rates would be bumped up. So even for HLL, once the increased royalty rates are in the numbers, people will look at what is left and start to value that. It's just that risk keeps hanging. They could have, like you were saying, charged even higher royalty. So have they said that they will not bump up the rates in the foreseeable future or something like that? So the limits today are just very wide. They used to be narrower. There was no logic for increasing the limits to such a high number. And again, to my mind, there is very little logic of companies charging such high royalty rates. Something that is being done globally doesn't give any credence to the fact that it should be done in all markets and in India, especially when it was not being done in the past.
At the current juncture, where to your mind there is value and opportunity? Where are you putting your money to work? Where are you confident that after the recent run-up also, double-digit gains are in store for us?
Banking and pharmaceuticals.
Banking is a large sector. I can think of 50 pharma companies. Let's be more descriptive here.
Okay, large cap, or let's say private sector banking and large cap pharmaceuticals. So, yeah.
Okay, I can think of 10 large cap banks and at least 30 large cap pharma names. You've got to be more descriptive in terms of what kind of businesses you're buying.
No, so yeah, okay. In banking, we were earlier focused only on, let's say, retail franchises. Going forward, as things improve, I think valuations of even, let's say, wholesale franchises or corporate franchises should improve. So, frankly, we are positive on banking, private sector mainly, but even the largest of public sector. In pharmaceuticals, the domestic companies, we do not expect numbers to be very good, especially companies who are focused on acute therapies. Because what has happened is in the north, winters have been extremely chilly, and frankly, it may sound funny, but I am told doctors used to go back home pretty early, so the prescriptions never got written. So already you have had one result in pharmaceuticals, the acute therapies have not done well. So any company which would have preponderance of acute therapies in the mix should not be expected to do very well in the September to December quarter. But otherwise, the export-oriented businesses and companies who have a more steadier disease profile should continue to do very well. So we are actually focused on the top 4 or 5 pharma names, not the rest of pharma names.
Within the energy basket, where is the focus right now? Oil retailers, exploration, refining stocks?
Yeah, that's been interesting. So we did get some exposure into downstream oil and refining. It's reasonably easy to understand, frankly, to our belief, the changes that have happened would probably all go to benefit the government and help it reduce fiscal deficit. We do not believe that the upstream would get any part of the increase in retail prices or reduction in subsidy. That's because government has taken a brunt of the price increases over the past 1 to 2 years. But yes, downstream would benefit because downstream theoretically was affected only because it used to get subsidy at the end of the year and hence had to bear the interest expense on the whole amount. So to the extent of interest saved, to the extent of lower working capital, the downstream would benefit. To my mind, we need to see more price increases going forward. We have taken one small step. I think the confidence in this space will increase if, let's say the diesel price increases stop over 6 rupees a litre. The gap to be filled is up to 9 rupees. So that is when, confidence will revert. We have to look at one thing that was proposed and where we really thought market has not focused is that they are proposing to value diesel subsidy, diesel GRMs on export parity rather than import parity. As of now, it's an 80-20 mix, 80% import parity, 20% export parity. From that, they are proposing it to be changed to 100% export parity. To give you a sense, for some of the refineries who have 50% diesel as a part of the refinery mix, it would end up cutting $1 from the total GRMs, and GRMs for the best of refineries is around 9. So it's a 10% kind of a shave off at the minimum if it gets implemented in the budget. So the other thing that investors need to be really focused on what is proposed in the budget in this space.
Are there any other pockets you're bullish on where you've allocated more than 5-6% of your total portfolio?
Some of the auto ancillary space. So those are very, very discrete names. So I can't take names.
Give me a flavor then. I respect your compliance, but again, my problem is auto ancillary is a wide basket.
Yeah. Well, we do like the battery space. Given the fact that a lot of it is a replacement market driven, and the profits are mostly replacement market driven. Given the fact that 3 years back the vehicle sales were pretty strong, you to expect those numbers to start to look better. So that's one space. The other is frankly diversified kind of entity, large one, and globally present. So basically, but the bottom line is that in auto ancillary spaces there are multiple companies, but all of them suffer from zero bargaining power vis-a-vis OEMs. There are very few who have the technical capability, distribution, brand, etc., which can command a premium in the replacement market and also have some degree of bargaining power with the OEMs. So I think we are with those 3 names out of I think 5 which will fall into the category. The key to focus on is who are those guys who can command some bargaining power with the OEMs.